We've got another real-life business question for Rocketblock's experts to solve in today's mock interview. Today's case is inspired by a BCG article highlighting the recent profitability struggle for auto dealers in the US. As a reminder, if you want to improve your casing skills, you have to be practicing actively and deliberately. You can start with a sizing question as a pop quiz. How big do you think the annual revenue is for the largest auto dealer group in Florida? The answer is inside this case and may surprise you. When you're ready to practice more questions like this, come to Rocketblocks where you can have thousands of drills to build your skills for real. Good luck and have fun casing.
So, your client today is Morgan Automotive Group. Morgan Automotive Group, MAG, is Florida's largest auto dealership chain, but it's operating in a challenging environment. The company does 8 billion in annual revenue entirely in Florida, but has been facing shrinking profit margins across multiple lines of business. Since 2023, the company has seen overall gross margin shrink from 19.1% to 17.3%. Your task is to assist Morgan Automotive in identifying strategies to enhance profitability under these constraints. How can they adapt to evolving market conditions to boost their bottom line?
Great. Before we jump in here, I just want to recap to make sure I understood everything correctly. So our client is Morgan Automotive Group. They're Florida's largest auto dealer chain. They generate 8 billion of revenue entirely in Florida, so really Florida focused. They have multiple lines of businesses, and they've basically seen profitability decline across all their lines of business in recent years. Specifically, gross margins have shrunk from 19.1 to 17.3%, so almost a 2% decline. And they've hired us to help them sort of understand how they can improve margins going forward. Is that correct?
That's right.
Perfect. Just a couple clarifying questions here. Does Morgan Auto Group have a specific goal in mind other than just improve margins?
Yeah, I mean they are long-term profit maximizing, but they're really focusing on, staunching the bleeding and then reversing the trend.
Got it. So if things just stop declining, that would be great, but
That
ideally
would,
go up.
I mean, ideally we'd get them back, right, to where they were. But yeah, step one, stop the bleeding. Step two, build back better.
Makes sense. And then you mentioned these multiple lines of businesses. I'm not super familiar with auto dealer and how they operate. Wondering if you can just give me kind of the 101 on how an auto dealer makes money, what those business segments might be.
Sure. Yeah. So there are effectively like two kind of like distinct lines of business that take place like at the point of sale, so at the new car sale. The first one is like the sale itself. There is a margin that that they take as effectively the retailer on that. And then the second is the financing, right? So as long as you actually have the option to finance with various companies when you buy a car, but if you choose to finance through Morgan or really through kind of their, financial partners, they make money off of that. So those are the two kind of like point of sale um, bits of margin. And then the third one is repairs, right? So, you can bring your car into the dealership. You don't have to have bought it there in order to bring it there. But so basically service is the other one.
Great. Well, thank you for that context. Is it okay if I just take a few moments to kind of gather my thoughts on how we can solve this?
Let's do it.
Perfect. Okay. So I think to look at this problem and really understand, how they can improve margins, it makes sense to kind of understand what's declining or what's causing it to decline today, and then kind of also thinking about opportunities. And so there's a few different buckets of things I'd want to look at to kind of answer both of those questions. I think the first kind of bucket I have is non-financial factors, and then the second bucket I have is financial factors. So starting within non-financial, there's some internal kind of company operation things I want to look at. So specifically, would want to understand their different segments, if there's different trends impacting their segments, if they're going up, down, flat. I would imagine they're mentioning that all the segments are declining across the board, but is it a different scale, for example, across segments? So is car sales flat and then parts are way down? I'd also want to understand a bit of our customer mix. Are we mostly serving consumers? Are we serving businesses that are buying, trucks or doing leases for their employees, for example, because businesses might be more stable than consumer purchases. So just trying to get a sense of that. Also would want to understand our employee base. So maybe how utilization is trending, how our employee retention is looking, because things like that can impact profitability. And so really it's just this first step is understanding the company's internal operations and if there's any kind of signals that we can gather from just kind of looking at the big buckets of the segments, our customers and our employees here. And then the second kind of thing I'd want to look at within non-financial factors is external factors. So looking at our competitors, so other dealerships in Florida, how are they performing? How are other dealers in the US performing? Is this an us specific trend? Is this a dealer-wide trend? Because that can kind of give us insight as to how much control we have over this. The other thing I would want to look at is just kind of macro trends. So I would imagine things like tariffs would impact these guys. I would imagine things like interest rates, if they have a financing arm, would impact these guys. General consumer sentiment might push down sales of new cars. So things like that, like are there any macro trends that are impacting the company at this time? So that's kind of external things that I would want to look at. And that kind of wraps up my non-financial bucket. Within financial, kind of basic two main things I want to look at. I'd want to look at one top line and two bottom line. Firstly, within top line, I'd want to look at unit sales. So that's, that could be units sold of cars. That could be what's the conversion rate for how much we're financing versus people are going elsewhere. What's our parts service sale volume look like? As well as the mix of the types of services. So I would imagine some services are, big giant repairs and some are, break fix, tiny. So what's tiny repairs? So what's the mix of those? Also would want to look at within kind of units is our path to purchase funnels. So our conversion rates from getting people in the store to how many are actually buying, if there's any trends there that jump out. And then I'd also want to look at, I think this is most relevant for services, but if how we think about general customer retention. So customer that comes in for their first service with us, are they coming in for the second, third, fourth? And so I've mentioned a bunch of things and kind of jumped around segments, but like at a high level, it's unit sales for all the segments and what that means for each segment. It's our path to purchase funnel and then kind of how we think about customer retention across the segments where I think that would be most valuable to look at for the parts and services business. So that's kind of the top line factors I'd want to look at. And then on the bottom line or cost factors, I'd want to look at COGS and OPEX. Within COGS, kind of looking by segments, how have costs of parts, the vehicle procurement costs changed, et cetera. And then on OPEX, kind of looking at the main line items for a dealership, I would imagine the big buckets would be rent, or you have this big building that you have to maintain. Like I would think the cost of maintaining that rent and facilities would be huge. Also marketing, like I just think you have a lot of ads for dealerships. I hear them on podcasts, I see them on TV, et cetera. Like I would imagine they spend a lot on marketing and then salaries and sales comp because I think they're people-driven businesses, right? You sell, you buy in the store. So I would imagine salaries are a big one. So those are kind of that's my hypothesis of the big OPEX line items. So would want to look at OPEX overall, but kind of focus in on those ones that I would think would be higher. And then I think and once we've looked at COGS and OPEX, I think it also would be important to do some benchmarking against our peers for those buckets to just kind of understand when we think about how could we improve margins, like what's the art of the possible here, like what's the maximum that we could theoretically get, these two as from a percentage of sales standpoint. So that's kind of the different buckets of things that I would want to look at. In terms of prioritization, I think it makes sense to start with the thing that I mentioned first, which is understanding the internal operations of the business, specifically the different segments, if there's any trends going on there. And so just curious if you have any data on, how the segments have been performing, any segment level financials, anything like that to just get a sense of if there's a particular segment that's driving this more or less or not.
Awesome. Definitely do and definitely want to get to that. I think before we do, one of the things that you mentioned, which I think is pretty interesting, is this idea of interest rates. Obviously, interest rates have been like top of mind, right? How would you think about like the way that rising interest rates like impact a car dealership?
Yeah, definitely. Um, so I think it would have the most impact on vehicle sales and then that financing division, and then there would be an ancillary impact on parts. So I'm going to answer this question kind of, I think, by segments. If I think of new vehicle sales, if interest rates are higher, the monthly payment that a customer is going to see when they're online browsing for cars, calculating their payment is going to be higher. And so I think customers may defer from buying a new car, like the life that a customer holds a car may get extended. So I would imagine new vehicle sales would be going down because of that. If you look at the financing arm, I would imagine that there's a couple things that could be happening depending on who your customer base is. You could have customers opt to pay cash more frequently. Customers may opt for more used or cheaper end vehicles because they don't want a huge finance. They don't want to finance a huge bill. And so you have less kind of amount that you're financing. Customers may opt for leasing more than financing because leasing is going to be a little bit cheaper month to month because there is the bullet pay down at the end versus financing. You don't have that, right? You pay it down to zero. Um, and so I think within financing, you're probably seeing a rise in leases. You're seeing smaller financing amounts. And then I would also think customers are going to be shopping around more as well, probably to try to find the best rate because they're just more aware of what rates are when they are volatile or increasing, et cetera. So that's that. And then within parts, I think but this kind of relates to the new sales bit that I mentioned. When it gets extended, when customers are extending their time of hold of a car, I would imagine they're breaking more, they have to fix them more. And so maybe part sales could actually be going up as a result of this. But we mentioned in the beginning that profits kind of going down across the board. But I would hypothesize now, kind of talking through this, that maybe there's the less of an impact on the parts business.
That's great.
Here's some feedback from Rob. It's a good idea to ask for a 101 overview of how the business works, especially if it's a new to you industry. It's important to understand how a company makes money. Abby's structure was simple with a breakdown between financial and non-financial, but Abby got creative and went deep on the things she wanted to analyze. Notice the standard profitability framework of revenue and costs nested within the financial bucket. It was a great use of outside information to reference tariffs, which will definitely impact the overall profitability of a company like Morgan. That said, there was an opportunity to reference another huge once-in-a-generation event of the COVID pandemic, which may have been artificially inflating profits at the start of the case. Abby did well to drive the case. In a candidate-led case, you should always be suggesting where you want to go and what your first priority is after you complete your framework. Abby did well to have a strong structured response to Rob's follow-up question and even reference her original framework as she was working through this recent wrinkle in the way she was approaching the case.
Awesome. So let's dive into kind of like the segment trends, right? We have data on not our clients specifically, but overall in the industry, kind of like where profit margins have been moving kind of like by these various lines of business. So I'm going to share something with you. Let me know when and if you can see it.
Yeah, I see it. Great.
Okay, awesome. And so the question here, right, are like, what are the key takeaways from the chart and how do they apply to our client?
Okay. So just confirming what we see here, I see we have kind of by quarter going back to 2023 to Q4 of 2024. We have gross margins of large auto dealers. And so I'm assuming this is the gross margin percent going down over time. And then we have the component of that from the different kind of segments that we just discussed. Is it okay if I just take a few seconds to read the chart quick before coming back with insights?
Yeah, please.
Okay. Um, so looking at this, three things sort of jump out to me. One is that all segments except after sale service and parts are declining in profit. So this kind of, impacting most of the business. And I would say being impacted by almost all of the segments are causing this decline in profitability. New vehicle sales is having the largest decline, which maybe relates to some of the things that we just talked about with interest rates. But there's basically an across the board decline on three of the four segments on this chart. Biggest decline in new vehicles. The second takeaway I'm getting here is this is kind of an industry-wide problem. So this is of all publicly traded US auto dealers. So it's not just Morgan Auto Group. So that kind of gets to this isn't something that our client is doing wrong. This is an industry-wide issue. Um, and so that maybe will change how we approach the problem. And then the third thing that jumps out to me is that after sale service and parts are the biggest contributor to profitability here for these dealers on average. So if you look at like Q4, for example, it looks like it's 30, 40, 40-ish% of the profit margin. And so that's interesting to me because I would have thought a dealer is just going to be more focused on car sales. So that's interesting. But in terms of kind of a next
The
step here,
secret is you got to sell really bad cars, and then they
and then
break
they
all the
keep
time.
coming back.
That's, that's the way to do it.
In terms of a next step, I think just given the decline in new vehicle sales has been so dramatic and used, I would just want to dive into more on what's driving this. Like, do we know anything that's causing this 17% CAGR over the last couple of years?
I mean, we don't have a perfect idea, but we do have some data in terms of like general trends. So, as kind of like one of your classic brick and mortar stores, car dealerships are certainly subject to, kind of have you heard of the internet?
I have, yes.
Apparently, it's coming for us. And certainly subject to some of the forces of online shopping. So we do have some data kind of on like online activity of, basically like the car purchase. And so I'm going to share that with you now. And so given this, right, what implications, what findings off the chart and what implications for our client?
Yeah. So just looking at this, confirming, see, we basically have a value chain that looks like the car purchase process. We have data on the percent of the activity that's conducted online versus in today versus 2030. So it's a forecast of kind of where we think the market is going. And it appears that must be based on a survey. So I'm just going to take a few moments to read this quick and then come back with insights. Okay. So looking at this, sort of two things jump out to me. I think one is that there's just a general expectation that things are going to go more online across the value chain. And so this could be impacting our client in a few ways. Like there could be less foot traffic in the door, so there's less people browsing cars. They could be just more competitive, right? So if customers can browse many dealers online, they're less likely to just go to the one that's closest to them. They may, shop around for different deals and prices, and so it just becomes a more competitive environment. I think when people are online, because it just increases transparency to customers. I think the second thing that jumps out is if the biggest jump in movement online that I see is at the end, this new vehicle order contract paperwork. So the last step in the value chain here, which could explain why new vehicle sales, or partially explain why new vehicle sales are seen as such a large hit. Um, but I think overall, looking at this, if the market's expecting things to go more online, for our client, ideally you don't want to like push back on this and try not to fight it off. You want to try to adapt and work with it. And so is there anything that we can advise our client to do to make the online experience for their potential customers and customers better, whether that be it's easier to, calculate a theoretical lease cost online. You can book your appointment to test drive a car online without having to call. You can do the whole purchase online if you would like. You can reserve a car online almost as if you bought it. So all you have to do is pick it up and just make that online shopping experience better because I think that could be a differentiator versus peers, perhaps. Because I haven't bought a car online recently, but I know if I make a dentist appointment and there's a dentist that lets me book online without calling, I will go to that dentist. And so I
I
think
will drive an extra 3 hours now instead of
I
5
will
minutes.
fly
Yeah.
somewhere. But yeah, I think that this could be an opportunity for our client to be kind of more digital forward, and we could help them with that.
Obviously, this is focused like on the, kind of that core new purchase, right? Like element. And we don't have any data on this, but like How would you think about, given the thing we just said, which is that like service is is actually like the biggest profit driver, right? What would you think about online activities in the service space? Like, what's important? What do you think's probably moving?
Yeah, that's a great question. I think it relates to some of the things I just said. So your ease of booking an appointment if something's wrong. I think your ability to just drop in and get it fixed. I think that's why people go to, like, say, a Valvoline to get their oil changed. They don't have to make an appointment. It's just a drive-through. Um, but if I think online broadly from a competitive standpoint, I would imagine mom and pops that maybe have lower scale than us, maybe for the first time. I mean, the internet's not new, but they have access to marketplaces where they can buy parts for cheaper and they can price compare and then they can offer lower prices. I think dealers already have a reputation for being kind of higher price service, but you're getting quality, et cetera. But maybe there is a world where just bigger ability to buy online. There's probably an online marketplace for parts, et cetera, that your competitors can source parts more cheaply. Non-dealer parts, I think there's a term for that. But then maybe the price gap between a dealer and a non-dealer is getting wider. I
Great.
would imagine that'd be positive for us from a margin standpoint, but also from a top line standpoint, we may just have less people in the door for service because of that.
Awesome.
Here's some feedback from Rob. Abby did well to describe what the data showed before diving in and looking for insights. She took a second to identify her insights and uses that time to rank and prioritize how she wants to share her finding. Abby continued to do well driving the case. Here she noted that top line sales were down and that would be a good place to start the investigation. Importantly, Abby is not just neutrally identifying what's in these charts, but she's using it as a jumping off point for solutioning and highlighting her own creativity and how to approach a problem like this.
Okay, so I've got one more exhibit I want you to work through here. I'm going to show you kind of like the gross margins or the the contribution to total gross margin by line of business for Morgan from kind of year one to year two, and I want you to calculate the decline that we've seen, both kind of by line of business and then overall.
Got it. Okay. Um, so what I'm seeing at the bottom is the margins you mentioned at the beginning. So that's 19.1 and 17.3 total margin. Um, and then it appears the contribution point, the rows sum to that margin.
That's right.
Um, so if I were typically calculating gross margin by segment, I would have segment level sales. But in this case,
Yeah, think about this as in the world's simplest universe where we made $19.1 million of margin, right? So imagine this was a $100 million business, right? We made 7.3 million of margin from vehicle sales. So think about it as contribution in that world.
got it. Okay. Makes perfect sense. So then I think to calculate kind of the impact that this decline in gross margin has had on our business, what I'll do is I'll take our total sales times the change in margin by segment. I might start with overall and then go by segment. So I would take, for example, the 8 billion times the 2% change in total margin, and that would give us the total impact. And then I'll kind of calculate the makeup of the contribution of that by segment. Does that sound like an okay approach to you?
Yeah.
Awesome. Okay. So if we are doing 8 billion in sales, we used to have 19.1% margins. Now we have 17.3. So that is like a 1.8% change. I'm going to round that to about 2%. Um, I know that 1% of a billion is 10 million. So 1% of 8 billion will be 80 million. So 2% about of 8 billion would be about 160 billion. I'm going to haircut that a little bit because I rounded up to two. So
160, 160 what? What unit?
160 million. Um, so about 150-ish million would be the total impact. So that's a lot. So the total impact decline in profit, that's a lot of money for this group. I didn't think that car dealers that were single state made this much money, so that is impressive to the owner of this group. Um,
Yeah, the Morgan family's doing all right.
yeah, they're doing very well.
I don't know if they own the Dolphins, but they should.
And then if I go kind of by segment, so starting with vehicle sales, so 7.3 less 5.9, that's going to be 1.4%. So the 1.4% decline times our 8 billion in sales. We know that 1% is 80 million, so about 1.5% would be about 120 million. So 120 million of our total 150-ish decline is from vehicle sales. Now moving on to financing, we have 4.5% less 3.9%. That is 0.6%. So a half a percent. I'm going to round to, so 80 million divided by 2, that's 40 million. So 40 million of the decline is from financing. And then if I go down to service, we have 7.3 less the, or plus the 7.5. So this is actually a positive improvement in margin, a positive 0.2%. So if 1% is 10 million, 0.1% is going to be 1 million, so times 8. So 0.2% would be 8 times 2, 16 million. So there would be a positive impact of 16 million from service. So summing those up, that gets us to about 150-ish million. We have 120 plus 40 minus 16. So that my total math I feel correct was correct. But my main takeaway from this is that the largest decline driver is really vehicle sales. And service is actually a bright spot here. We're basically holding our ground and improving even a little bit, even though it's a marginal improvement in an overall declining kind of market that the industry overall is facing profitability. That's kind of promising to me.
Awesome.
Here's some feedback from Rob. This is a weird set of data, and Abby does a good job to clarify the information she's looking at before diving into the calculations. She did well to use shortcuts to convert from billions to percentage of contribution first before getting into her math. She only actually had to then convert from dollars one time instead of after each and every calculation. Importantly, Abby isn't just doing calculations to demonstrate her math skills, she's calculating to look for client impact. In this case, she highlights that the main takeaway is to focus on vehicle sales.
Well, I mean, good news for you. You arrived at the right answer. Bad news for the project team is that our timeline has been cut short, and we're only going to be able to focus on one of these lines of business. Which line of business would you focus on and why?
Okay. I think I see the point in focusing on vehicle sales if it's declining the most. You'd want to try to turn things around, but I think turning things around in a declining market is going to be hard. I think service I find interesting that even in a declining market we're increasing. So I think I would try narrow it down to between those two, but I would lean towards service. So I think my current answer would be to go with prioritizing service for a few reasons. I think one, as I mentioned, if it is increasing in a declining market, maybe there is some opportunity to push pricing to market more, et cetera, and drive more foot traffic. Maybe there are some macro kind of tailwinds, so people holding cars longer, et cetera, that can push them in the door for us. I think two, it is the biggest component of profits for dealers overall. But I think looking at that past chart, um, it is for us as well. And so I think if it's the biggest component for profit overall, I think that just logically to me makes sense as a place to prioritize because it seems like that's kind of the cash cow of the business. So there's kind of less, if you make a mistake in changing things, trying to move profit around, it's less likely to have a huge impact on the business because you just have more flexibility there. So that's why
Yeah.
I think I would say prioritize service for a couple of reasons. I think it's one, they're doing all right in a declining market, which shows promise. And two, it seems like they're more of a cash cow of the business, big profit generator for us. And so we maybe have more flexibility to try things to turn things around.
I mean, I think the counterpoint to that maybe is like I would say like maybe twofold, right? Which is we talked about like financing and new car sales as though they are separate, but they're kind of like, two parts of a single transaction, right? It's kind of like they're linked. So that's like one big thing in some ways,
Yeah.
right? And then the other thing is like maybe you do have to sell the car to really get the service, right? So maybe it's actually like the customer acquisition. What would you say to that?
Yeah, I guess if you combine the financing with the new vehicle sale, then those two combined are a big chunk of our margin.
Yeah.
I get that. But to me, they're still separate. Like they're probably different skills or different people that are doing that. There's probably a finance person in a back office running numbers. You're basically a bank if you're a financing arm, and then there's the salesperson. And so for that reason, to me, it feels like two separate businesses and the ability to shop around. Like I don't know if everyone finances through a dealer, especially with like the rise of SoFi and things like that online, that makes things easier for people to shop around. And then your second point that you made just on, can you
Which
repeat?
is more like it's selling the original car is customer acquisition for the service division.
Yeah, I think that is totally fair. I think it is. However, if new cars are down overall, then I think getting new customers in the door is going to be harder for the service bit as well. So is there anything we can do to try to get customers who have already bought cars to come to us versus use a Valvoline or a mom and pop instead? Um, because I get that if it's declining, like why fight super hard for something that is declining when if there's something that is doing all right, I think there's still opportunity to kind of retain our existing customers rather than go after new. Um,
Great.
Here's some feedback from Rob. Abby does well to use this as an opportunity to demonstrate conviction. Rob pushes back on her original answer and she stays strong.
Awesome. All right. CEO walks in the door, slams open the door. He's a very grumpy person, Mr. Morgan. Demands to know what your kind of like recommendations are on like where to look for improving profitability.
yeah, is it okay if I just take a few moments to gather my thoughts?
Yeah, please do.
Okay. So to improve profitability, um, I think I'd recommend that the Morgan Auto Group prioritize two things. One would be um, focusing more on how to grow the service segment of the business. That segment, despite kind of overall macro trends hurting dealerships, the service segment has been doing fine. And so is there anything that we can do there to keep that growing? So maybe we increase prices because if customers are still coming in the door despite a tough, macro environment for cars broadly, maybe there's an opportunity there. Two, maybe there's more marketing that we can do with our parts and service business to drive more people in the door. But I think just given that that is been okay in a declining market is kind of a silver lining here. And I think if there's anything we can do to double down and potentially grow that more would be a great opportunity. The second recommendation would be to invest in, more digital capabilities or a website. I think one thing we found is that people are forecasting broadly car buying activities to go online. So people will be probably coming into a dealership less. And so how can we win customers online more going forward? And I think the way to do that would be to have a super modern, easy to use website. And so we would love to help you kind of invest to build that or how give you some advice about how you can improve the website. But I think taking a step back, two main recommendations would be one, prioritize growing service, and two, invest in digital. And then in terms of next steps, would love to help you kind of figure out what's the best way to do this. Like what exactly could you invest in for digital and how could you grow service? But that's our recommendation as of now.
Awesome. Thanks so much.
Thanks.
Here's some feedback from Rob. Abby had a strong recommendation, including great structure to help walk through the main idea of the case. There's an opportunity here to be a little bit more concise, but it's not something that he would ding her for.
Hey everyone, it's Kenton Koveski here, the founder of Rocketblocks. Thank you so much for watching this mock interview video. I hope you found it informative and helpful as you are getting ready to prepare for your own interviews and hopefully landing that job offer you are excited about. We have a ton of great content on the Rocketblocks channel coming out on a weekly basis, mock interviews, mini lessons, and chats with our Rocketblocks experts. So if you haven't subscribed yet already, please do so. There is a big red button below. And if you hit that, you'll get all of our content as soon as it comes out. Thanks for watching and have a great day.